All right, let's dive in. Who says tax forms are just dry numbers and, endless regulations?
hmm
What if I told you they often hide genuine opportunities for surprising savings? For many of us, tax season feels like trying to navigate a dense jungle without a map.
Yeah, it definitely can feel that way.
But believe it or not, nestled within those very forms are powerful tools designed to reduce what you owe. Today, we're taking a deep dive into a topic that touches the lives and pockets of countless families: the Child and Dependent Care Credit.
Ah, yes, a really important one.
It's a bit of a hidden gem, often misunderstood or even completely missed, yet it can be a significant avenue for tax relief and a real game changer for your financial bottom line.
What's truly fascinating about this particular credit is how precisely it's designed to recognize specific expenses,
Mm,
which, when you properly understand them, can directly reduce your tax liability for your 2024 returns.
right.
We're not just talking about a deduction that lowers your taxable income. This is a credit. It directly chips away at your final tax bill.
That's a huge difference.
It really is. That makes it incredibly valuable for anyone managing care costs.
So our mission today is to cut through the jargon of IRS Publication 503, that's the official guide on this, and give you a powerful shortcut to being well informed.
Mhm.
We'll break down exactly what the IRS is looking for in terms of requirements, how the calculations work, and precisely how to claim it, all with a sharp eye on maximizing those precious tax-saving opportunities.
Get those savings.
Exactly. Consider this your essential guide to navigating this crucial part of your 2024 tax return and ensuring you don't leave any money on the table. Think of us as your guides, helping you unlock these savings. Okay, let's get into the mechanics then. Before we even dream about how much you could save, you first have to clear some, well, very specific hurdles.
Yes.
Think of this first segment as the essential gateway to the Child and Dependent Care Credit. To claim it, you have to pass 7 specific tests, miss just one, and unfortunately, the credit simply isn't available to you.
Precisely. These are non-negotiable hurdles, and the IRS lays them out very clearly in Publication 503. Understanding each one is absolutely paramount because they form the very bedrock of your eligibility.
Right.
It's like building a house. You need a solid foundation first. Let's begin with the first, and arguably one of the most critical: identifying who you're paying care for.
Okay, so that's the qualifying person test. This means the care you paid for absolutely must be for one or more specific qualifying persons that the IRS identifies on Form 2441.
Mhm.
It's not just any person, they have to fit a very particular definition. Generally, a qualifying person falls into one of 3 categories. First, your dependent qualifying child who is under age 13 when the care was provided. So think of your younger kids.
Okay.
Second, your spouse if they were not physically or mentally able to care for themselves and lived with you for more than half the year.
Right, that's an important one too.
And finally, another person who was not physically or mentally able to care for themselves, lived with you for more than half the year, and was your dependent. Or perhaps they would have been your dependent except for a few very specific reasons.
Right, like maybe their income was just a bit too high.
Exactly. Such as having too high a gross income, which for 2024 is $5,050 or more, or if they filed a joint return, or if they could be claimed as a dependent on someone else's return.
It's important to clarify a nuance here regarding that dependent definition, especially after the recent tax law changes. While personal exemptions for yourself, your spouse, or your dependents have been suspended for tax years 2018 through 2025,
Meaning the deduction is zero.
right, the actual deduction amount is zero. The criteria for determining who is a dependent still rely on those pre-suspension rules. So, for example, for a qualifying relative, their gross income still has to be less than that $5,050 to meet that specific dependent test. This isn't about claiming a monetary exemption anymore, but about meeting the IRS's definition of a dependent for the purpose of this credit. It's a foundational detail that can, well, trip people up sometimes.
Here's where it gets really interesting and often catches people off guard, potentially costing them valuable credit. What if your child turned 13 mid-year, let's say September 16th?
Ah, yes. The birthday rule.
The rule is incredibly precise. Only expenses incurred before their 13th birthday count. So in that example, you can only count care expenses through September 15th. Why is the IRS so sharp on that line? What's the practical implication for parents?
Well, that precision really highlights the credit's core intent. It's designed to help with childcare expenses to enable work, not general adolescent supervision or education, which typically becomes less direct after age 13.
Okay.
A common pitfall is just forgetting to adjust your expense tracking on their birthday, potentially overstating eligible expenses.
Yeah.
The key insight here is mark that birthday on your calendar and adjust your records immediately.
Good.
And, similar precision applies to dependents born or who passed away in 2024.
Yeah.
They're treated as living with you for more than half the year if your home was their home for more than half the time they were alive in 2024.
Right.
This is a common situation that requires careful tracking of dates and expenses for accurate claiming.
And tying into the identification requirements, you must include the name and taxpayer identification number, or TIN, which is usually a social security number, and SSN of each qualifying person on Form 2441. Failure to do so means the credit may be reduced or even completely disallowed.
Definitely need those numbers.
And for non-resident or resident aliens who don't have an SSN, an ITIN, or individual taxpayer identification number is used.
All right.
For adopted children without an SSN, an ATN or adoption taxpayer identification number is required.
Right.
And here's a crucial reminder about ITN. If your ITN wasn't included on at least one U.S. federal tax return for the last 3 consecutive tax years, it expires on December 31st of that third year and must be renewed before you use it again.
Oh, that's a really important heads up. Easy to forget.
Yeah, it's a detail that can easily lead to disallowance if not addressed proactively, so always check your ITN status.
Another common area of confusion, and one that trips up many families, particularly after divorce or separation, involves the special rules for divorced or separated parents.
Yes. This gets complicated.
It can seem that way, but basically, even if you, as a parent, can't claim your child as a dependent for general tax purposes, they might still be a qualifying person for your child and dependent care credit.
Really? How does that work?
It applies if the child was under 13 or disabled, received over half their support from their parents combined, was in the custody of one or both parents for more than half the year, and this is key, you are the custodial parent.
Custodial parent meaning?
The custodial parent is the one with whom the child lived for the greater number of nights during the year. This is a very specific carve-out. It's designed to ensure the parent who's actually incurring the care expense can claim the credit, regardless of who gets to claim the child as a dependent elsewhere on their return.
So if you're the non-custodial parent, even if you pay child support, and maybe you even claim the child as a dependent for other things based on your divorce decree, you cannot claim the child independent care credit for that child.
That's exactly right. That's a vital distinction. This rule ensures the credit goes to the parent who is physically providing the home and, crucially, incurring the work-related care expenses.
Makes sense.
It's a common point of confusion that leads to errors, so understanding this can save you from an IRS headache down the line.
Okay, on to test number 2, the earned income test.
Yes. This one's pretty fundamental, too. To claim the credit, you and your spouse, if you're filing jointly, must have earned income during the year.
And not just any income, right? It has to be earned income.
Precisely. Income from services you performed. This includes things like wages, salaries, tips, other taxable employee compensation, and net earnings from self-employment.
What about self-employment if it's really small, like under $400?
Good question. Yes, even if those self-employment earnings are less than $400 for Social Security tax purposes, they still count as earned income for this credit. It also includes strike benefits and any disability pay you report as wages.
Gotcha. And one key insight here for tax optimization, especially for military families, is the election to include non-taxable combat pay in your earned income.
Ah, yes, that's a helpful provision.
This can potentially boost your earned income figure, which in turn can give you a larger credit or maybe help you meet the earned income threshold if your regular pay is lower.
Right.
So if your spouse and you both received combat pay, you can each make your own decision about this election. It's a specific provision designed to help maximize tax benefits. Definitely a tax-saving strategy to consider.
And what is not considered earned income is equally important because it directly affects whether you qualify. Think of it this way. Earned income comes from your active work wages, salaries, self-employment.
Right.
What doesn't count are passive income sources. Things like pensions, annuities, Social Security benefits, workers' compensation, interest, dividends, unemployment compensation.
Okay.
Or most scholarships, unless they're reported on a W-2 for teaching or services. The IRS is making a clear distinction. This credit is tied to your active participation in the workforce.
So if your income primarily comes from, say, investments or retirement benefits, it generally won't count for this specific credits earned income test.
Exactly. Child support received also doesn't count, nor does income earned by a non-resident alien that's not connected to a U.S. trade or business. And income earned while an inmate in a penal institution doesn't count either.
Now, there's a special rule for a student spouse or a spouse not able to care for themselves. This seems important.
It is. This is a significant provision that allows you to qualify even if one spouse isn't actively working in the traditional sense.
How does that work?
If your spouse is a full-time student or physically or mentally unable to care for themselves, they are treated as having earned income for any month they meet that criteria.
Ah, so it's like pretend income for the test.
Sort of, yes. It's called imputed income. For example, if they're a full-time student, they must have been enrolled for some part of at least 5 calendar months during the year.
Oh, okay.
Now, this rule applies to only one spouse for any given month. So if both you and your spouse are, say, full-time students in the same month, only one of you can be treated as having this imputed earned income for that specific month.
Right.
This imputed income plays a crucial role in meeting the earned income limit, which we'll discuss later, and directly impacts your ability to claim the credit and, therefore, your tax savings. It essentially creates a placeholder for income when actual earned income might be zero or very low.
Got it. Okay, third test, the work-related expense test.
Yes, this is absolutely fundamental.
Yeah.
Your expenses must allow you or your spouse, if filing jointly, to either work or actively look for work. And they must be specifically for the qualifying person's care. If the expense isn't tied to your work or looking for work, it generally won't qualify.
Yes. The IRS is quite particular about the purpose. When we talk about working or looking for work, this can be for others or in your own business. It can be full-time or part-time, in or out of your home.
Mm-hmm.
Actively looking for work also qualifies, but here's a critical detail. If you don't actually find a job and have no earned income for the year, you can't take this credit, even if you incurred expenses looking for work.
Right. The earned income test still applies there.
Exactly. The purpose is key. An expense isn't considered work-related merely because you happen to incur it while you're working. The purpose of the expense must be to allow you to work.
Right.
For example, the cost of a babysitter while you and your spouse go out to dinner is not a work-related expense.
Definitely not.
However, if you work during the day and your spouse works at night and maybe sleeps during the day, paying for care for your 5-year-old child during the hours when you are working and your spouse is sleeping is considered a work-related expense.
Because it enables your employment.
Right. It's about enabling your employment. It's not just about spending money. It's about spending it for a specific work-related reason.
There are also some interesting nuances here. Volunteer work, for instance, where you receive nominal or no pay, doesn't count as working for this purpose.
Okay.
Also, temporary absences from work, say for a vacation or a minor illness lasting 2 weeks or less, can still include care expenses if you had to pay for the care anyway.
So if the daycare still charges for the week.
Exactly. If your child's daycare charges a weekly fee, even if they're absent for a few days because you're on vacation, those days still count. But if you're out of work for an extended period, maybe 4 months due to illness, and continue to pay a nanny, those expenses would likely not be considered work-related for that specific period.
Makes sense.
And for part-time work, generally you'd figure expenses for each day. But if you're required to pay for care in a way that includes both days worked and days not worked, like a fixed weekly fee, you could figure your credit including the expenses for days you didn't work, but only if a cheaper option for just the work days isn't available.
Ah, okay. So if the center only offers a 5-day package for $250, even if you only work 3 days.
Then the whole $250 can be a work-related expense. Oh. But if they did offer a $150 3-day option, you'd be limited to the $150.
Got it. That distinction is crucial for maximizing eligible expenses while staying compliant. All right, moving on to the fourth test, the payments to non-dependent relatives test.
Yes, this is an area where assumptions can lead you astray.
You cannot claim the credit if you make payments for child and dependent care to certain people. Who are they?
Okay, you can't pay someone you claim as a dependent on your tax return.
Mhm.
You also can't pay your own child, stepchild, or foster child if they are under age 19 at the end of the year, even if they're not your dependent.
Even if they're 18 and doing the babysitting?
Correct. Under 19, no go. You also can't make payments to your spouse. And you can't make payments to the parent of your qualifying child if that child is your child and under age 13.
Okay, so you can't pay your child's other parent if the child is under 13. Why is this rule in place?
That's a great question. It really speaks to the IRS's intent to prevent, well, the artificial shifting of income or expenses within a family simply to gain a tax credit where no genuine arm's-length care expense was really incurred.
Right.
For example, paying your 18-year-old to babysit their younger sibling, that payment doesn't qualify. It's about ensuring the care expense is a true cost incurred to enable your work, rather than just moving money around the household in a way that doesn't really reflect the economic support the credit is designed for.
Prevents abuse. Makes sense. Okay, test number 5, the joint return test.
The general rule here is pretty straightforward. If you are married at the end of the tax year, you generally must file a joint return to take this credit.
Pretty standard for many credits. Are there exceptions?
Yes, there are crucial exceptions. You aren't considered married for this purpose and can file separately and still potentially claim the credit if you are legally separated under a decree of divorce or separate maintenance.
Okay.
Or you might qualify if you are married but living apart, provided you meet 4 specific conditions. First, you have to file a separate return. Second, your home must be the qualifying person's home for more than half the year. Third, you must pay more than half the cost of keeping up your home for the year.
And fourth.
And fourth, your spouse must not live in your home during the last 6 months of the tax year.
Okay, all 4 need to be met.
All 4, yes. These exceptions are designed for very specific circumstances where married individuals effectively live as separate households.
And what counts as costs of keeping up a home?
That's also precisely defined. It usually includes things like property taxes, mortgage interest, rent, utility charges, home repairs, insurance on the home, and, importantly, food eaten at home.
What's not included?
It specifically doesn't include payments for things like clothing, education, medical treatment, vacations, life insurance, transportation, or mortgage principal payments. And it doesn't cover major purchases or permanent improvements like replacing a whole roof versus just patching a leak.
Got it. Details matter there.
They do. And one more quick point. If your spouse died during the year and you don't remarry before the end of the year, you generally must still file a joint return with your deceased spouse to take the credit for that year. If you do remarry, the credit can potentially be claimed on the deceased spouse's final separate return.
Okay, number 6 is the care provider identification test. Seems simple, but maybe not.
It might seem like a small detail, but it's absolutely critical for getting your credit approved.
Yeah.
You must identify the care provider on Form 2441, meaning providing their name, their address, and their taxpayer identification number. That's usually an SSN or ITIN for an individual, or an EIN, employer identification number, for an organization like a daycare center.
What if it's like a church or school program?
If the care provider is a tax-exempt organization, you can simply write tax-exempt in the space for the TIN.
But what if you can't get the number? Like the babysitter just won't give it to you?
That's where due diligence comes in. The IRS requires you to show you made a reasonable effort. If the information is missing or incorrect, your credit might be disallowed unless you can demonstrate that due diligence.
So how do you show that?
Keep records, like a completed Form W-10, dependent care provider's identification and certification signed by the provider, or maybe a copy of their Social Security card, or a completed W-4 if they're your household employee, or even just a letterhead or invoice from them with their information.
Okay.
If a provider absolutely refuses to give you their identifying information, you should still report whatever you do have, like their name and address. Then, for the missing info like the TIN, enter See Attached Statement on Form 2441 and attach a statement to your return explaining that you requested the information, but they didn't provide it.
So document your attempt.
Exactly. That demonstrates your due diligence and can protect your credit. And for U.S. citizens and resident aliens living abroad whose care provider is foreign and doesn't have a U.S. TIN, you can enter LAFCP, which stands for Living Abroad, foreign care provider in that TIN space.
Good to know. Okay, finally, the 7th test, and this sounds like a big one for tax savings, the Dependent Care Benefits Exclusion Deduction Test.
Yes, this is a major consideration for maximizing your overall tax savings. It involves how employer-provided benefits interact with the credit.
So like money from a flexible spending account, an FSA?
Exactly. If you receive dependent care benefits from your employer, maybe through direct payments, or the value of care at an employer facility, or those pre-tax contributions via an FSA, these benefits are often excluded or deducted from your income.
Which is good, right? Lower income.
It is good, yes. But this test states that the total amount you exclude or deduct must be less than the dollar limit for qualified expenses, generally $3,000 for one qualifying person, or $6,000 for 2 or more in order for you to claim any credit on the remaining amount of expense
Whoa, okay, so the benefits affect the credit.
directly. Since the maximum exclusion for dependent care benefits is typically $5,000 or $2,500 if married filing separately, it's always going to be less than the $6,000 limit for 2 or more qualifying persons. But here's the crucial tax saving point.
Mm.
These employer benefits directly reduce the pool of expenses you can use for the credit itself.
How so?
If you exclude, say, $4,000 in dependent care benefits from your income, and you had $6,000 in actual care expenses for 2 children, you effectively only have $2,000 left. $6,000, $4,000 that can even potentially be used to calculate the credit.
Ah, okay, so you can't double dip.
Precisely. Understanding this interaction is absolutely vital for making the most tax-efficient decision for your family. We'll dive into this more deeply now as we talk about the actual calculation. Okay, so if we connect this to the bigger picture, once you've successfully navigated all those eligibility tests, passed all 7 hurdles, the next crucial step is strategically calculating the credit.
This is where the rubber meets the road for tax savings.
Exactly. And it involves understanding several layers of limits and rules that can significantly impact your final tax benefit. It's not just a straightforward sum. It involves several careful considerations.
Let's start with figuring total work-related expenses. For your 2024 tax return, you can only count expenses you actually paid by December 31st, 2024 for care that was received in 2024.
Right, the timing matters.
This is a common area for confusion. What if you prepaid expenses? Say, in December 2023, you paid for January 2024's daycare.
That expense counts for your 2024 return because that's when the care actually happened, when it was received.
Okay. And conversely, what if I had 2023 care costs but didn't pay the bill until 2024?
Those 2023 expenses paid in 2024 can potentially increase your 2024 credit, but you have to figure it separately. There's a worksheet A in the Form 2441 instructions for that specific situation.
Okay.
And if you have 2024 expenses you won't actually pay until 2025, you can't count them for your 2024 credit. They'll potentially be claimed on your 2025 return when you pay them.
So the key insight here is the credit is tied to when the care was provided, not just when you opened your wallet.
That's the main principle. Furthermore, reimbursed expenses cannot be counted. This is a key tax-saving nuance to grasp.
So if my employer paid some of it back?
Exactly. If your employer, or maybe a state social services agency, reimburses you for employment-related expenses under a dependent care assistance program, those reimbursed amounts don't count as work-related expenses for the credit.
Makes sense. Example.
Sure, if you paid $3,000 for care, but your employer reimbursed you $2,000 through your FSA, you can only use the remaining $1,000 of your out-of-pocket cost to figure your credit.
So reduce eligible expenses by any reimbursements.
Correct. This ensures you're not getting a double tax benefit on the same dollars.
And there's an interesting sort of strategic overlap with medical expenses, right?
Yes, this can come up, especially for qualifying persons who aren't able to care for themselves due to physical or mental issues. Some expenses might actually qualify as both work-related dependent care expenses and deductible medical expenses.
So you have a choice.
You do. And it's a critical one for maximizing your overall tax benefit. You could use them either way, but you absolutely cannot use the same expenses to claim both the credit and a medical expense deduction. It's one or the other.
What's the strategy then?
Well, if you use these expenses to figure the dependent care credit first, and they end up exceeding the earned income limit, or the dollar limit, which we'll cover in a second, you can then add that excess amount to your other medical expenses for the deduction.
Oh, okay. So you get a second chance with the leftover amount.
Potentially, yes. However, if you initially use your total expenses to figure your medical expense deduction on Schedule A, then no part of those expenses can be used for the dependent care credit.
So it's an either-or, but using it for the credit first might let you use the excess for medical.
That's often the strategic play, but you need to run the numbers for your situation. Also remember, any amounts you excluded from your income under your employer's dependent care benefits plan can never be used to claim a medical expense deduction.
Okay, good clarification. Now let's talk about what specifically constitutes care of a qualifying person.
Right. Expenses are considered for care only if their main purpose is the person's well-being and protection. Think direct care activities.
What doesn't count?
Generally, expenses for food, lodging, clothing, general education, and entertainment don't count. However,
There's always a however with taxes.
seems like it. Small amounts paid for these items can be included if they are incidental to and cannot be separated from the cost of caring for the qualifying person.
With the daycare lunch example.
Exactly. If a nursery school provides lunch as an inseparable part of its childcare service, the entire cost, including the lunch portion, can count. But things like child support payments never count as care expenses. It's about the direct hands-on care.
Education expenses seem tricky. You mentioned nursery school counts, but kindergarten doesn't.
That's right, and it's a common pitfall. Expenses for a child in nursery school, preschool, or similar programs for children below kindergarten level do count as expenses for care. But expenses to attend kindergarten or any higher grade generally don't count as care expenses. The exception is specifically for before or after school care for a child who is in kindergarten or a higher grade. That part can count.
So the school tuition itself doesn't count, but the wraparound care might.
Precisely. And summer school and tutoring programs, even if they keep your child occupied while you work, are considered education, not care. So those costs don't qualify for this credit.
Okay, so a summer day camp might be okay, but a math tutor isn't.
Generally, yes. If you send your 9-year-old to a summer day camp offering various activities, the full cost may be a work-related expense because it's viewed as daycare. But if you send your 10-year-old to a 2-hour daily math tutoring program, that cost is not for care. The IRS draws a very fine line there.
Good to know. What about care outside your home, like daycare centers?
The cost generally qualifies if the care is for your dependent under age 13 or for any other qualifying person who regularly spends at least 8 hours each day in your home.
And the daycare itself.
Dependent care centers, like licensed daycares, must comply with all state and local regulations to be considered eligible providers whose fees qualify.
You mentioned camps before. Day camp, okay. Overnight camp, not.
Correct. The cost of sending your child to an overnight camp is not considered a work-related expense. Doesn't matter if it allows you to work.
Why not?
The IRS views overnight camp as different from daytime care. However, the cost of sending your child to a day camp is considered a work-related expense, even if it specializes in something like computers or soccer. The critical difference is that overnight component. It's about daytime supervision enabling work.
Okay. And what about transportation? Getting the kids to daycare?
Another nuanced area. Only transportation provided by the care provider counts.
Meaning the daycare bus picks them up.
Exactly. If the actual care provider transports the qualifying person to or from the care location, maybe by bus, subway, taxi, or even their private car, that cost can be included.
But if I drive them?
Your own transportation cost to take your child to daycare, or, say, the nanny's cost to commute to your home, do not count as part of the care expense for the credit. It has to be an integrated service from the provider.
Got it. What about various fees and deposits, like application fees for preschool?
Yes, those can often be counted. Agency fees paid to find a care provider, deposits paid to preschools to hold a spot. Application fees, these can be work-related expenses if they are necessary to obtain the care, even if they aren't for the care itself.
But what if I pay a deposit and then, change my mind?
Good question. A forfeited deposit is not considered work-related if the care isn't actually provided. So if you paid a deposit for preschool A, then decided on preschool B and lost the first deposit, that forfeited amount cannot be counted. The care must actually be rendered for the expense to qualify.
Okay, makes sense. Shifting focus slightly, household services can also qualify sometimes.
Yes, this is important for people who have help in the home. These are ordinary and usual services done in and around your home that are necessary to run your home and are at least partly for the well-being and protection of a qualifying person.
Like a housekeeper who also watches the kids.
Exactly. Services of a cook, maid, babysitter, or housekeeper can count. But not, say, a chauffeur, bartender, or gardener. Those aren't primarily for care or running the household in the same way.
This raises an important question. What if the services are partly for the qualifying person and partly for others, like older kids who aren't qualifying persons or just general house upkeep?
That's a common scenario, and the publication offers a helpful example. Let's imagine the Millers again, a couple with a 9-year-old child who is a qualifying person, and a 14-year-old teenager who isn't due to age. They hire a housekeeper to care for both children so they can work, and the housekeeper also does normal household cleaning.
Do they have to split the cost?
The good news is, not necessarily. You don't have to divide the expense if only a small part is for other purposes or non-qualifying persons. Even though the 14-year-old isn't a qualifying person, the entire expense for the housekeeper can potentially be work-related because it's partly for the care of their 9-year-old qualifying person.
That's a crucial distinction. So even if the housekeeper benefits the whole household, if A significant part is for the qualifying person. It's potentially all eligible.
Potentially, yes. But here's the catch we hinted at earlier for the Millers. Even though their housekeeper cares for 2 children and the full expense might be work-related, the dollar limit for the credit, which we'll discuss next, would still be based on having only one qualifying person in this specific scenario.
Because only the 9-year-old meets the age criteria for the credit.
Exactly. So while the expense might qualify, the limit applied to that expense is based only on the number of actual qualifying persons. It's a vital distinction for calculating the credit correctly.
Okay. And what about providing meals and lodging for the housekeeper?
Those expenses can also count as work-related expenses, but only if they're extra expenses incurred because of the employment.
Like renting a bigger apartment.
Yes. If you move to an apartment with an extra bedroom, specifically for the housekeeper, the extra rent and utility expenses for that bedroom can be counted. But if they just move into an existing spare room, maybe only the extra utility costs would count, not the base rent or mortgage.
Makes sense.
And here's a very important detail, often overlooked, a genuine hidden tax saving. The employment taxes you pay on wages for qualifying child and dependent care services.
Like Social Security and Medicare taxes for a nanny.
Precisely. Those employer taxes are also considered work-related expenses for figuring this credit.
Oh, wow. That's a great way to boost your eligible expenses.
It absolutely is, assuming you're also fulfilling your household employer responsibilities correctly, which is a whole other topic we'll touch on briefly later.
Okay. Now let's really dig into dependent care benefits and how they dramatically affect the credit calculation. This seems like where careful planning really matters.
It absolutely is. This is where strategic decisions can lead to significant tax savings, or, conversely, missed opportunities.
These are the benefits often shown in box 10 of your Form W-2, right?
Correct. They include things like direct payments from your employer to you or your care provider, the fair market value of care your child receives in an employer-sponsored facility, or those pre-tax contributions you make to a dependent care flexible spending arrangement, or FSA.
And if your employer provides these under a qualified plan, you can often exclude or deduct them from your income. Up to how much?
Generally up to $5,000 per year for single filers or married couples filing jointly, or $2,500 if you're married filing separately.
So what does this all mean for your credit? You said it reduces the credit.
Yes, this is the key tax saving point and the crucial interaction. If you exclude or deduct dependent care benefits from your income, which usually saves you taxes up front, that excluded amount is not included in your work-related expenses for the credit calculation, and it directly reduces your dollar limit for the credit.
Ah, the double impact.
Exactly. You can't get both the full value of the exclusion and the full value of the credit on the same dollars spent. The exclusion often provides a greater tax benefit, especially for higher earners, because it reduces your taxable income directly, potentially saving you tax at your marginal rate. But it comes at the direct cost of reducing the pool of expenses available for the credit, which is calculated at a lower percentage rate.
So it's a trade-off. You need to figure out which saves you more overall.
Precisely. Understanding this interplay is essential for strategic tax planning and choosing which benefit or combination works best for your specific tax situation.
Okay, let's talk about the limits then. First, the earned income limit.
Yes, this is a fundamental gatekeeper for the credit amount. The amount of work-related expenses you can actually use to figure your credit cannot be more than your earned income for the year if you are single.
And if married, filing jointly.
If you are married and filing jointly, the expenses you use cannot be more than the smaller of your earned income or your spouse's earned income for the year.
The smaller amount? Ouch!
Yes, the lower of the two incomes sets the ceiling for the expenses you can consider for the credit. And this limit applies for the entire year, even if you were only married for part of it.
What about separated spouses meeting those specific living apart rules?
If you qualify under those special rules to file separately, you use only your own earned income for this limit.
And surviving spouses?
A surviving spouse filing a joint return may take into account their deceased spouse's earned income for the year they died, but they aren't required to. And importantly, community property laws are disregarded for this calculation. It's based on your actual individual earned income.
What about self-employment earnings again?
For this limit, you include your net earnings from self-employment, generally from Schedule SE, even if they're less than $400.
And is there any flexibility there if self-employment income is really low or negative?
Potentially. If your net earnings from self-employment are low, or you even have a net loss, you might be able to use an optional method to figure your net earnings for self-employment tax purposes. Using this optional method could potentially increase your earned income for this credit's limit calculation, possibly helping you qualify for a larger credit than you otherwise would.
Another strategic point for self-employed folks?
Definitely something worth exploring with tax software or a professional if your self-employment income is volatile, as it can directly impact your credit eligibility or amount.
Now, let's circle back to the student or disabled spouse's imputed income. How does that fit into this earned income limit?
It fits in directly and is often essential for families in that situation to qualify. Remember, if your spouse, or you, on a joint return, is either a full-time student for at least 5 months or is physically or mentally unable to care for themselves, they are treated as having earned income. At least $250 per month if there's one qualifying person needing care, or $500 per month if there are two or more qualifying persons needing care at any time during the year. This applies for each month they meet the student or disability criteria.
So, when calculating the earned income limit for a married couple, you use that imputed amount for the student disabled spouse.
You use the higher of their actual earned income for the month, if any, or this imputed amount, $250 or $500. That becomes their earned income for that month when determining the lower of the two spouses' incomes for the limit.
Okay. And still, only one spouse can use the imputed income per month if both qualify.
Correct. If both spouses happen to be full-time students or disabled in the same month, only one can be considered to have this imputed earned income for purposes of the limit calculation. The other spouse's earned income for that month would be their actual earnings, if any.
Let's use an example. How does this work in practice?
Okay, Publication 503 gives a good one. Imagine Jim works and his wife Sharon is unable to care for herself for 11 months of the tax year. Jim pays $3,300 in work-related expenses for Sharon's care. Jim's earned income is, say, $29,000.
Okay.
Sharon has no actual earned income, but she was disabled for 11 months. Since there's one qualifying person, Sharon, her imputed income is $250 per month. So for the 11 months, her total imputed income is $2,750. 11 by $250.
Right.
Now, their earned income limit for the credit is the smallest of these three amounts. $3,300, their actual work-related expenses, $29,000 Jim's earned income, or $2,750, Sharon's imputed earned income.
So the limit is $2,750.
Exactly. Even though they spent $3,300, they can only use $2,750 of those expenses to calculate the credit because the earned income limit, driven by Sharon's imputed income being the lowest figure.
What happens to the extra $550 they spent? $3,000 is $2,750.
That excess $550 could then potentially be treated as a medical expense, assuming it meets the other requirements for medical expense deductions. This shows how the imputed income can limit the credit, but might open the door for other deductions.
Okay, that makes sense. But what if neither spouse has actual earned income, like your student-disabled couple example earlier?
Right, that example highlights the absolute necessity of the earned income requirement. Let's revisit Karen, full-time student all year, and Mark, disabled all year. Neither has any actual earned income. They pay $5,000 for Mark's care.
One of them gets imputed income, right?
Yeah.
$250 a month since Mark is the qualifying person.
Yes, one of them can be deemed to have imputed income, 250 months, so $3,000 for the year. But the earned income limit for a joint return is the smaller of the two spouses' earned income.
Yeah. So one spouse has $3,000 imputed income, the other has $0 actual income.
So the smaller amount is $0, which means their earned income limit for the credit is 0.
So no credit at all, even with $5,000 in expenses.
Correct. They fail the earned income limit test because the lower income is 0. This clearly shows how essential it is for both spouses, or the single filer, to meet some level of earned income, actual or imputed, and considering the lower of rule, to actually qualify for any credit amount.
Wow, that's a tough outcome, but shows how the rules interact. Okay, next limit, the dollar limit.
Yes, after applying the earned income limit, there's another cap. The dollar limit on the amount of work-related expenses you can use.
What are the numbers?
The fixed limits on the expenses you can use for the credit are $3,000 if you paid for care for one qualifying person, or $6,000 if you paid for care for two or more qualifying persons.
So max $3,000 in expenses for one kid, max $6,000 for two or more that you can even start calculating the credit on.
Exactly. This is a yearly limit, and it applies regardless of how long during the year you actually had that qualifying person or paid for their care. If you had one qualifying person at any point, you use the $3,000 limit. If you had two or more qualifying persons at any point, use the $6,000 limit.
This is where the direct tax savings potential gets capped, regardless of how much you actually spent above these amounts.
Correct. And it applies even if, say, You had two qualifying children, but you only actually incurred expenses for one of them.
Like our Miller example again. If they had a 3-year-old and an 11-year-old, both qualifying persons, maybe at the start of the year before one aged out, and spent $6,000 only on the 3-year-old's daycare.
Even though they only spent money on one child, the Millers could still potentially use the $6,000 limit to figure their credit because they had two qualifying persons in their household at some point during the year.
How would they show that on the form?
On Form 2441, you list all qualifying persons. In that scenario, you might list $6,000 in expenses for the 3-year-old and $0 for the 11-year-old. The form uses the number of qualifying persons listed, 2, to determine the $6,000 limit applies.
So the key is the number of qualifying persons you had, not necessarily how many you spent money on. That seems like a great opportunity if you're in that situation.
It can be. Now remember that interaction with dependent care benefits. That comes into play right here with the reduced dollar limit.
Ah, yes, the FSA money reducing the limit.
Exactly. This is a crucial tax-saving point that often gets missed in the calculation. If you receive dependent care benefits that you excluded or deducted from your income, you must subtract that excluded amount from the dollar limit, $3,000 or $6,000, that applies to you.
So the $3,000 or $6,000 is just the starting point.
Right. Your actual effective dollar limit for calculating the credit is figured on Form 2441, Part 3, after accounting for those excluded benefits. This is critical.
Let's use those IRS examples again to make it super clear. First, George, widower, one child, $2,900 in expenses. His employer paid $1,000 directly for care, which George excluded.
Okay. George has one qualifying person, so his starting dollar limit is $3,000, but he excluded $1,000 in benefits. So his reduced dollar limit for the credit is $2,000, $3,000 minus $1,000.
Even though he paid $2,900 out of pocket.
Correct. He can only use $2,000 of those expenses to figure his credit because the exclusion directly reduced his limit.
Wow. Okay, second example. Randall, married, 2 kids, $6,000 in expenses. He took the max $5,000 pre-tax exclusion through his FSA.
Randall has two qualifying persons, so his starting dollar limit is $6,000, but he excluded $5,000 via the FSA.
So his reduced dollar limit is $1,000.
Exactly. $6,000 minus $5,000 leaves only $1,000. Even though he paid $6,000 in qualifying expenses, he can only use $1,000 of those expenses to calculate the actual credit amount.
These examples really drive home how much those dependent care benefits impact the credit itself. You really need to weigh the value of the upfront exclusion against the potential credit amount.
Absolutely. Often the exclusion provides a larger overall tax saving, especially if it saves you tax at a higher marginal rate compared to the credit, which is calculated at a lower percentage, 20-35%.
Yeah.
But you have to compare for your own situation.
Okay, so after all that figuring expenses, applying the earned income limit, applying the possibly reduced dollar limit, we finally get to the amount of credit, the payoff.
Yes, the moment of truth. To determine your actual credit amount, you take your work-related expenses, the final amount, after applying both the earned income limit and the dollar limit, and multiply that number by a percentage.
And that percentage depends on?
It depends on your adjusted gross income, or AGI. That's the number usually found on Form 1040, line 11.
What are the percentages?
The percentage starts at a generous 35% for taxpayers with an AGI of $15,000 or less. Then, the percentage gradually decreases by 1% for each $2,000 or part of $2,000 or above $15,000 until it bottoms out at 20% for taxpayers with an AGI over $43,000.
So lower income gets a higher percentage back.
Correct. 35% for AGI up to $15,000, phasing down to 20% for AGI over $43,000.
This is the final calculation that determines your actual tax saving. It's a direct reduction of your tax liability.
That's the key. It's a credit, directly reducing your tax bill dollar for dollar, not just a deduction reducing taxable income. So if your AGI is over $43,000 and you had $1,000 in expenses eligible for the credit, like Randall in our example, your credit would be $200, 20% of $1,000. If your AGI was under $15,000 and you had $2,000 in eligible expenses, like George, your credit would be $700, 35% of $2,000.
And remember, even if one of your qualifying persons had 0 expenses, like the Miller example, as long as you had 2 or more qualifying persons, you start with that higher $6,000 limit before reducing it for any dependent care benefits. You have to list all qualifying persons on Form 2441 to get that higher limit applied correctly.
Precisely. The Roger and Megan Paris example in Publication 503 illustrates this. Well, they list both children, even though one had $0 expenses, which allows them to start with a $6,000 limit, which then gets reduced by their $1,000 exclusion, leaving $5,000 in expenses expenses subject to the earned income limit and the AGI percentage. Proper form preparation is essential here.
Okay, we've navigated the maze of eligibility and calculations. Now let's transition to the practical side. How do you actually claim this credit? And what are some crucial, maybe easily overlooked considerations?
Right, getting the numbers right is half the battle, but ensuring they're reported correctly and understanding potential pitfalls is key to actually realizing those savings and avoiding headaches later.
So, how to claim the credit? Once you've done the hard work of figuring out your eligible expenses and limits, how do you tell the IRS?
It's relatively straightforward at this point. You need to file Form 1040, 1040 SR for seniors, or 1040 NR for non-residents. The absolutely essential part is completing Form 2441, Child Independent Care Expenses.
That's the specific form for this credit.
Yes, you must complete Form 2441 and attach it to your main tax return, Form 1040 SRNR. Form 2441 is where you list your qualifying persons, detail your care providers and their TINs, show your calculations for eligible expenses, factor in dependent care benefits received, and figure the final credit amount.
And where does that final credit number go on the main form?
The final credit amount calculated on Form 2441 then flows to Schedule 3, Form 1040, Additional Credits and Payments, specifically Line 2.
Okay. Now, a really important constraint you mentioned earlier. This credit is non-refundable. What does that mean again for tax
But
savings?
this is a key point that can sometimes surprise people. Non-refundable means the credit is limited to the amount of your actual tax liability. It can reduce the tax you owe down to zero.
But it can't give you money back if the credit is more than your tax.
Exactly. If your calculated credit is, say, $500, but your total tax liability for the year before the credit is only $300, the credit will wipe out that $300 tax bill, but you won't get the remaining $200 of the credit back as a refund.
So it saves you money you would have owed, but doesn't create a refund beyond that.
Correct. Unlike a refundable credit, like the earned income tax credit or parts of the child tax credit, which can result in a refund even if you owe no tax. This one stops at zeroing out your tax.
Given all these details, rules, and calculations, meticulous record keeping seems absolutely essential.
Oh, absolutely critical. This is your best defense if the IRS ever has questions about your claim. And honestly, it just makes your life so much easier when tax time rolls around each year.
What should you keep?
You should keep clear, organized records of all your work-related expenses receipts, canceled checks, bank statements showing payments to providers. Keep track of any dependent care benefits you received from your employer, like statements showing your FSA contributions and reimbursements. And if applicable, keep records documenting the nature and length of a qualifying person's disability. And as we stressed earlier, it's absolutely paramount to keep that care provider identification information readily accessible.
The Form W-10, copy of SSN card, invoices.
Exactly. Keep
Yeah.
copies of those things. Having these records organized will make filling out Form 2441 accurately much smoother and provide immense peace of mind.
Now, for something you flagged as a potential hidden complexity, do you have household employees? This sounds like it could be a big deal.
It really can be, and it's something many people who hire in-home help are completely unaware of.
When does this apply?
If you pay someone to come into your home and care for your dependent or spouse, think about a nanny, an in-home senior caregiver, maybe even a house cleaner. If a significant part of their job involves child supervision and you, the person hiring them, control not only what work is done, but also how it is done.
Like setting their hours, telling them how you want the kids cared for.
Precisely. If you have that level of control, that person is likely considered a household employee by the IRS.
Not just an independent contractor.
Not usually in that scenario, no. And being a household employer triggers potential employment tax responsibilities for you. This goes way beyond just paying their hourly wage or salary.
This raises an important question. Many people probably don't think of themselves as an employer just for hiring a nanny. What taxes are involved?
You could be responsible for withholding and or paying Social Security and Medicare taxes, often called FICA, federal unemployment tax, if you NDA, and potentially state unemployment taxes. You might also need to withhold federal income tax if the employee asks you to and you agree.
Wow, so you need an employer identification number, EIN.
Yes, if you have household employees and need to pay these taxes, you'll generally need to get an EIN from the IRS. And you'll likely need to file Schedule H, Form 1040, Household Employment Taxes, with your personal income tax return each year to report and pay these employment taxes.
How do you distinguish this from, say, using a daycare center?
The distinction is usually about control and the nature of the relationship. Daycare centers are businesses. The workers are employees of the center, not you. Nannies hired directly by you to work in your home are generally your household employees.
What if you use an agency?
It depends. If the placement agency sets the rules, dictates how the work is done, pays the worker, and handles the taxes, then the worker is likely the agency's employee, not yours. But if the agency just provides you with a list of potential sitters, and you hire one directly, pay them directly, and direct their work, that sitter is very likely your household employee.
This is crucial to understand.
It really is, because it comes with significant compliance responsibilities. You also have to indicate on Form 2441 whether you paid cash wages to a household employee that are subject to employment taxes. And don't forget, you likely also have state employment tax obligations, so checking with your state's unemployment tax agency is a necessary step. It can be a significant hidden cost and compliance burden if you're not prepared.
Definitely something not to overlook if you have in-home care. Okay, so we've covered a lot of ground. This deep dive is really designed to give you that quick yet thorough understanding of the Child and Dependent Care Credit. Hopefully it allows you to approach your tax forms with more confidence. But of course, for specific personal tax advice or if you need help preparing your return, the IRS does offer many resources.
Yes, definitely check those out if you need more tailored help.
You can visit irs.gov for all sorts of information and forms. There are free services like IRS Free File if your income qualifies, VITA, that's Volunteer Income Tax Assistance, or TCE, tax counseling for the elderly, military members have meal tax, and you can access your own online IRS account for information.
Lots of avenues for help.
Yes, those resources are invaluable. But hopefully, this deep dive provides a concentrated shortcut to getting well-informed on this particular credit. #, outro. So, what does this all mean for you? We've really unpacked the Child and Dependent Care Credit today. We went from defining precisely who qualifies and what specific expenses actually count,
Getting those definitions right.
to navigating the crucial earned income and dollar limits, which can really change the final number. We also highlighted how those employer-provided dependent care benefits interact with this credit, a key area for maximizing your overall tax savings.
That interaction is huge.
Understanding these intricate details, all laid out in IRS Publication 503, can genuinely translate into tangible tax savings on your 2024 return. It's really about knowing the rules and applying them diligently, turning that complexity into clarity and ultimately into savings.
Absolutely. And, knowledge is most valuable when it's understood and then applied. This deep dive truly empowers you, the listener, to approach your tax filing with greater confidence.
Right.
Knowing you've thoroughly explored this particular avenue for reducing your tax burden is powerful. It encourages that critical thinking about your expenses and how they align with these specific tax law provisions, allowing you to optimize your situation. Every dollar of credit you can legitimately claim as a dollar saved, directly reducing your tax bill. It really is about making the tax code work for you, not against you.
Well said. So, as you look at your own situation, maybe juggling childcare costs and work, consider this final thought. How might proactive planning around your dependent care expenses, keeping this credit and all its intricate rules in mind, influence your financial decisions and overall tax strategy, not just for 2024, but maybe for the years to come?
Thinking ahead.
The power of a little knowledge applied thoughtfully can indeed lead to a lot of savings. Thanks for diving deep with us today.